Okay, good morning, traders, and welcome to this live intraday strategy webinar on SB Trade Desk. Today is Thursday, March 11th. Great to be with you guys this morning. Agnes, Jay, Sam, Ted, great to everyone be with you guys, with everyone in the room. So there's not a lot necessarily that we want to go into depth on. I want to cover everything that we've been talking about. I'm kind of getting, I want to say the word is trigger shy, but it's been a very interesting couple of days. So we were waiting for the dollar rally to exhaust and pull back. That exhaustion and pullback has now materialized, but I'm now looking for support. And the pullback, while it's broken the weekly range, is now coming in some areas where it's not really advantageous for new positioning. And at the same time, I don't want to fight it just yet. So on the list for today, we're going to hit DXY, Euro, Dollar CAD, SPX, Sterling, Kiwi, Dollar Yen, Aussie, Gold, and we'll just take a quick look at that 10-year and crude oil charts again. I've been showing you the long-term charts on this, but worth taking a look, I think, into the close of the week. I'm a little tight on time today, so I'm going to try to run through these. Hey, Ted, good morning to you as well, sir. Let's jump right in. DXY into the start of the week. Check this out. So we talked about this for a while. I appreciate all your guys' patience over the last 3 weeks. I've been running a pilot series webinar with Daily FX, which has been kind of throwing off our schedule here. We're back to normal again next week on Tuesday and Thursday, but we've been following this DXY sort of crest for some time. This was published back on the 7th, right, as we were opening up the week. And the level that we were focused on to the Sunday open were these two regions right here, 92.28 into 34, and then the 618 into 92.62. We broke and turned right in between, and the turn lower took out the weekly range lows, and we just took out the September low. So on whole, it's important to remember where we're coming from on the DXY. Here's the weekly chart. Again, like this is what we showed on Monday. This is what we showed on Wednesday. It's the same region of critical resistance, 92.28. We never got a weekly close above it. Intra-week it pushed, but even the levels on the intraday charts held. Here's what the daily chart looked like. So not quite as clean here, right? This is why we were looking for 92.68. Here's the turn, but pretty outspoken. I don't want to say full outside, but a reversal candle taking you lower right off momentum. Pretty significant region after a 4-day rally into fresh multi-month highs, looking for the pullback. Now that pullback, again, is coming into an area of interest. Here's your slope support. 3rd day back. Here's the intraday chart, and here's how it looked back on Monday. So again, here's the Monday open. We rip, again, turning just ahead of that 618. Break of channel support, and we're right back at the median line. This uptrend wasn't added yet. We've now since sort of put some color there, but that 38.2, that 2017 low day close, well, that's above, or just below rather, a basic 38.2 of this near-term stretch off the February low. So a nice zone, right? We want to see the downside start to exhaust in this region if we are heading higher in the dollar. Hey, Sam says, how do you prioritize daily levels and the intraday levels after working from the longer term weekly levels? Great question, Sam, and I could go into a whole webinar about that, my man. So the weekly chart, Sam, think of it as your compass. So Sam, you're going from New York to LA. I know I need to head west, right? That's my weekly chart. I know the direction, at least, that I'm heading. Your daily chart is sort of your interstate highway. So I need to hit, I need to get to Route 66 at some point. I'm in Jersey, so I got to get through, the Garden State Parkway or the Turnpike, whatever. And then your intraday chart, Sam, is your right-left turn, literally like your turn by turn. So I can have a longer term view on the trade, but I can think that we're bullish. We're at uptrend resistance. Near term, I could definitely take a downside position against the broader trend. And so it's magnitudes of trend, right? Now, if you're talking about actually like trading your levels, again, it depends what you're doing. Sam, if you're looking for a longer term swing trade, then you're still focused on the closes. You don't want to necessarily be so intricate with the intraday, intra-week high. You want to be looking at those larger closes, the daily closes, the weekly closes. If you're intraday trading, much nearer term, then yeah, you want to give a lot of credence to these levels. But again, the confluence regions are always going to be our best zones. So sorry to go off on a tangent there, Sam. Hope that adds some color. Marchin, you got a little list there. I'll hit you right after. Hey man, says sorry for being late as usual. No worries. Great to see you in the room as always. So good question, Sam. Let's see how this DXY trade pans out. So here's euro in reference to where we were on Sunday. Again, here was the Sunday open. We were looking for that drop into the 100. There was 118.07. Didn't quite get that low. That essentially dropped into 1835. There's the 1807 level before turning. And here's a breach of the weekly opening range highs on Thursday. Leaves the risk for, sure, a little bit more of a recovery before return. Sort of like in DXY, again, gives DXY a little bit more room on a push. If we do draw towards that median line, towards that 91.40 region, but you get the picture. Okay, if we break back below the weekly open, like 119.16 in euro, if we break back below slope, I'm right on board. We do think broader resumption is lower. It's just that, again, big trail. Let me take you back to the weekly charts here. Sorry, guys, jumping all around. Here's the weekly chart. 118.35. What was that? I don't think I had it highlighted here on the intraday chart, but we had it on the weekly, and we can always go to the previous charts and check out the weekly. And there it was, 1835. It's the actual August high week reversal close from 2020, last year. So big pivot in price. We highlighted this back on the 3rd of the month as an area of confluence. Now, again, ahead of schedule here, but here's the rebound. And on a closed basis, this is what concerns me. On a closed basis, despite the fact we dropped that low, look what this looks like. A rebound off basic channel support? Man, I'd be remiss to start making that assumption just yet. So we have to be a little patient here. Could get a little bit more upside. I want to see 120 hold resistance on any approaches if this is heading lower. And you need that buckle below 118. Here's the daily chart and the intraday chart we've been following. We need this close below this zone here to unleash a deeper drop towards 1770s, and 117 is the big whopper down there. So precarious positioning, all things held constant, guys. Take a step back, try to be as objective as possible. Here's your monthly open. You set a monthly range high, you set a monthly range low. We're right slap in the middle towards the lower bounds, but you get the picture. Respect that range. All the hesitation that you hear from my end right now and kind of like this tiptoeing is with the respect, guys, that next week, we have the FOMC on tap. And you guys know how we feel about that stuff. A lot of noise. You're gonna get a lot of opinions and all kinds of assumptions and analysis on what the Fed said. But to be frank, it's going to get the updated quarterly projections with growth, employment, and inflation. So certainly we do need to pay attention to that. That's major event risk next week. And we'll want to see if that shakes things up here for these dollar majors. But for now, could see a little bit more lift, ideally looking for exhaustion ahead of 120. That's number 2. Number 3, here's Loonie. So we do have the Canadian employment figures on tap tomorrow. Expectations for a print of 75,000. Remember, last month we got that blowout negative read of 212,000. So certainly the unemployment rate there upticking 9.4. We're actually expecting that to downtick tomorrow again to 9.2. All else, dollar CAD is in not a very good spot. Okay, not a very good spot. Here's what we look like into the start of the week. So You guys remember on this one, I got stopped out on this ripper, on this drop last week before it finally rebounded again. Maybe it had a schedule on that long position, but another opportunity to rebound here kept us in the range right into the weekly open. That range held through BOC. We saw a downside break today, and now we're seeing this dribble back towards slope support and back into key support. Here's dollar CAD, just a reminder on the weekly chart. It's do or die here. Like, if this gets me again, I'm going to be pretty upset, but here's what it looks like. It's support. Again, just as a disclaimer, I don't personally have anything on this yet, but this is the big support structure that we talked about. Here was the big reversal, outside reversal off the lows almost. And here we are yet again. The entire yearly range, guys, consists of this just zone ahead of the 2018 Open, 26 handle, right there. So here's the intraday chart that we started looking at into the start of the week. And on this pullback, we wanted to find support here or here, and that's the focus. What's the problem with that? Well, tomorrow we have Canada employment report out. This to me looked like a break of the objective weekly opening range. If we settle any somewhat below 25.75, I'm not going to fight this. I'm not going to take a long. At the same point, I'm not going to short into multi-month. I mean, this is multi-year lows. Like, it's a very, again, I'm kind of just split down the middle. Ideal scenario, fairy tales and ponies. I would want this thing to drop down, and you'll find exhaustion with either a spike low into this or U.S. markets open today and we just take off. And I'd rather jump in a little bit late, but have the conviction. At the end of the day, it's all about this range. Until it happens, sit tight. Again, CAD employment on tap tomorrow, and then we have the FOMC on tap next week. So super interested to see how this pans out. Now, interestingly, we'll look at crude prices as well. I don't even want to touch that correlation right now, but it's also at a very interesting juncture in time as well. So we want to take a look at the implications for that. Last but not least from that update was the SPX. SPX had made a rebound off of key support. That was 37.34. We were looking for the buckle higher, and it was either an exhaustion off one of these two regions needed to happen for the downside to remain sort of in focus. Here's SPX now. We just blasted through. This is the high day close at 39.34. So as I was talking with someone yesterday in the webinar, they were asking, what did you mean by we're not out of the woods yet? Well, I mean just precisely that. From a slope standpoint, that's a breakout. From a trend continuation standpoint, until we clear that high day close, it's very promiscuous. Very, 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 be careful. Even if I just dump this, just forget that slope. All things held constant, I wouldn't want to be buying into that. Now, a daily close above, the resumptive trade takes you into slope resistance. A measured extension takes you into like 4,079. But you get the picture. Use some caution here. Still not out of the woods until we clear that high day close on a close basis. Remember, that high day close wasn't just the record high day close. It was an outside reversal close off the highs that we then once again tested and posted another outside day reversal last time we tested that on February 25th. So definitely a level I'm paying close attention to here into the close of the week. Okay, that was SPX. Sterling, following day, looked like this. Super boring this week, right? There wasn't really much to do on this. It was kind of a slow grinder. We didn't get a drag all the way down into support, but we definitely broke the top side. We're kind of testing this zone right now. Here's Sterling. So this is critical. It turned out, we slapped this on the webinar yesterday. It turned out that this was an exact 2 equal legs off the high, takes you into 39.94. We've been watching 39.95 for months. So I'm looking for inflection. Looking for inflection. Some of these trades can get frustrating because we're really looking to get more assertive on some of these moves. But we just have to be patient. Lots of event risk on tap, and we're ranging. There's a lot of range bound action. So you want to respect those because the break will ultimately yield you a more conviction, a stronger conviction, I should say, on your directional bias. All right, so not much to update on sterling, guys. No change to any of those levels. You know, you can tack on the new extension that gives you that 100 there, but it converges here anyway. We're looking for some sort of reaction. If this breaks, the 618 of this drop turns out being at 40.66, which is just a decent pivot in price. So you'd be looking for a reaction up there, but it's all about what happens right here today and into the close of the week. Ultimately, a break below like 38.57, that swing low that we made for the opening range of the month, or last week, I should say, that would give us a little bit more of a conviction turn lower. Any questions on pound? On tap tomorrow, you do get the 3-month GDP moving average. I mean, I wouldn't really put too much credence on there, although the expectation is for a pretty dismal read at negative 2.5%. So that's all you'll pretty much have to worry about until we get into the BOE on the 18th. So getting hit with both sides with interest rate decisions for sterling dollar next week. All right, that's pound. Here's Kiwi. And here's how it looked back on the 8th. So New Zealand dollar was coming into a key support after, so I can't even stress this enough. I know I've talked to you guys about this level for a while, but you know, really, really important. Why? It's also the yearly opening range low, like objectivity. Let's say I didn't like any of your fibs, Mike, and I don't, you know, approve of your reference points or whatever you want to argue. Objectively, it's the yearly range lows, right? Objectively, it's basic trendline support. That's the third touch. And then add to that, you know, the 50 of the 2014 decline, the 786 retracement of the 2017 decline, all right here, right? So we need to see a reaction. We're getting an initial reaction, but it's the rebound. Here's what it looks like on the daily chart. So initially, we turned with more of a bearish tone on this after that reversal candle. Remember, all the dollar crosses were doing it together. Momentum broke back below 70 after a quick probe. We put a focus lower well below the high day close a couple of days after that turn. Here was the monthly open. Here was the break. Took you back into the yearly range lows. Key support. Remember, this is your yearly open. And here's the rebound. It's got to fail either here at the monthly open. That's what these dotted lines are at 72.35, or at the previous high day close for January, which converges on slope just below 73. So same trade, that recovery that we're getting in the drawdown in the dollar after the rally, right? The recovery in the crosses against the dollar is coming up against the first sort of major hurdle that you'd want to see hold. So big level for Kiwi, still need to clear 71 to get this, you know, going. You could make the argument that was a false break of major key highs, of the yearly range highs right there that you made. Whatever have you, it's all about whether we find resistance on one of these two levels on this recovery. Here's what it looks like on the intraday chart. Right now, we're testing not only the March open, but the 38.2 retracement of this drop. So that's 72.35, 72.38. Let's see how the market opens in the US trade session today. Again, even if it spikes higher into the close of the week, let's say this was a break of the weekly opening range, which is how I interpreted it. You're looking for a Thursday, Friday high. If it probes for another press, 72.85. I don't have it on here. That's the high day close right around here. would be the region you'd start to look again for possible exhaustion. But that's it. Anything beyond that, and you're back in the broader uptrend. So looking for topside exhaustion in Kiwi ahead of 73 if we push higher from here. Ultimately, it's all about this zone. It's all about this 71 zone. Again, I mean, it's your yearly range lows. It's critical. All right, so that is Kiwi. 5 and 6. All right, any questions there? GDP figures for Kiwi, don't forget, come on tap. They're midweek next week, but it's like the same day as the FOMC. So, jot that down if you are looking at any Kiwi positioning. Levels remain unchanged. The only thing we're adding here is just the retracement that we added for the new low. All right. The abomination. Who's involved? Who's involved? We'll come back to the gold trade in a moment. That was like a textbook trade this week. I hope some of you caught that. But here's dollar yen. Man, that ended up being the high. Well, so far. Big level. It was a slope, okay, that we were looking at for some time. But if you go back to the previous updates as well, the longer term charts for that really were looking at a pretty big critical level just higher into that 618. We never quite closed there yet, or we haven't closed there yet, but here's the stretch. Okay, here's long-term slope resistance. Here's momentum heading into 70. So it's been a this would be the fourth consecutive weekly advance into upslope resistance for the pitchfork we're following off the lows, and downslope resistance. Paying close attention to this, specifically into the close of trade this week, but I mean, even near term, here's what it looks like, right? Upslope resistance, reversal candle that we made back here on the 9th, and this is the key support level, 108. That's the level we need to close below to validate a near-term reversal in price. Even then, it would be a reversal off uptrend resistance, would just be a corrective stance within the uptrend. But the whole stance on this has to be against 108. Yeah, man, gold coming right up. I got you. So no new, excuse me, end of the week. I've been tongue twisted by all these webinars. No new changes or no changes to the levels for dollar yen. Here's what it looks like now. And here's what it looked like again back on the 9th. It's just been a boring trade, like this one has been tough to actually put a handle on, but all things held constant, I just love where and how it turned. Divergence in momentum and overbought into uptrend resistance. Here's the pullback. You can't make any assumptions till you sink sub 108. Okay, so that's number 7. Here's Goldie, man. I'm going to go out of order a little bit and get you that gold update. Here's what it looked like, again, just a few days ago. So massive area of support. We talked about the 618 retracement of the decline off the highs. There we go. Or the range rather for last year. 1690 is all about 1690. Getting a little bit of a pop higher here. The bearish invalidation level, my mind would still be 1763. So you could get a little bit more upside here, man. I wouldn't get super comfortable just yet. So man saying, and by the way, guys, I'm super restricted on daily FX webinars to be able to engage a little bit more freely. So if you throw me a level or you ask me specific, I might not be able to respond, although I'm keeping an eye out for all of you guys always. But man, if you're still holding that long, the one thing I would just caution you is not to get too comfortable ahead of this region. So let me just show you here. So first, well, I guess we're there right now. Monthly open resistance, median line, downtrend resistance. We're there now. For your part, you want to close above 1734 for this to be a conviction turn, or at least a near-term reversal higher. You had a lot of things working for you this week, man. I definitely give you the credit on that long position. We talked about it when it first happened right here on the 8th. We made an outside day reversal lower through support to fresh yearly lows. That's like your exhaustive, like red flags everywhere. It took us a while. We got another reversal and push higher. Once the weekly opening range started to clear, it looks like it's in for a nice little pull higher here. So I do like the concept of it. From this level though, E-Man, here's the 120. I don't like this slope so much at this point. Kind of looks a little messy to me. I was looking at different derivations of it, but for a lack of, in the absence of a new slope, right? Here's your monthly open. This is the 4-hour reversal close, outside reversal close, 1734. So we haven't been able to actually clear that with some conviction. If tomorrow's low, yesterday when we were talking about this, I was talking about the bullish invalidation level near term being at the weekly open. I choked that up to yesterday's low. So if we start to head anything sub 1708, which is just beyond the weekly range highs, the opening range highs, I'd start to get concerned that that's kind of all she had. It took after the 4-hour candle close. Man, is this a recent long or is this from yesterday? Two days ago, after we got 1670, okay, 1676 low, right on. Excellent positioning, well done, absolutely. So interestingly enough, just some interesting wave counts here, give you 1750 on the upside, Eman, if we do hold support, or if we do hold the median line, or if we push higher through that high, that would be 2 equal legs off the low, converges on the upslope, basically into the close of the week here. All right, well played. Get more defensive. The only thing I would say is don't get too comfortable until we clear the monthly open with a close basis. Make sense? All right. To maximum, says E-Man, right on. All right, so that is gold, number 8. Here's Aussie. I probably should have hit this right after Kiwi, but it's a very similar scenario. Here's where we caught Aussie earlier in this week. We had just made a very clear weekly opening range right above critical support. It is Kiwi. It's the same exact setup, right? So the risk was, as we had highlighted, after this decline, here was the daily chart, still holding 40 on momentum, coming into a 38.2. We posted an outside, I think, if I'm not mistaken. Yes, outside reversal off the lows. That's why I probably had it in the writing there. Excuse me, guys. It's getting towards the end of the week. But so the outside reversal there off the low shifted the focus and gave us a little bit of a threat for a larger recovery in price towards the median line. Bearish invalidation is all the way up here. That's near 78.36, basically the 78 handle. So the weekly opening range setting up right above support, guys, these are like our easiest, at least from a directional biases indicator. These are like the easiest tells when they're so close. So 1, 2, 3, prop, here's the push higher. So the first level we talked about was 77.60s, I believe I noted, was where it was back then. As we were coming into this region here, or 77.50s I even might have put. But at the end of the day, this is your big zone. Here's the first test, just higher is going to be that 78 handle. And that's where you want to start to see, guys, exhaustion if we are heading lower in Aussie. So the whole assumptive move again that the Aussie came and made a huge weekly outside reversal off the highs, failed to break that key resistance level near 78, keeps us thinking that we still have another draw lower, divergence with a trigger break already materialized in momentum, has me looking for exhaustion. If Aussie's heading lower, we want failure ahead of 78.36. Quick rendition of just near-term retracement. Oh. Puts us at the 38.2 right now. The 50 is in that zone anyway that we're looking at. And I just wanted to highlight that the 618 actually does converge on, let me just leave that on, I guess. It converges on the high day close, which is always going to be a key level for me. So that's like 78, 70, 78, 60. I don't want us to get that high, but just a level that would sort of put us right on the resumptive trade. One other thing I wanted to consider as well, bear with me, is just with this quick extension on close. That puts the 100 here as well. Looking for topside exhaustion, but to get a conviction trade on this is going to be tough with all the event risk that's on tap next week and all the hoopla. Just if you're not already exposed, if you don't already have positioning, chill out. It would be my best suggestion here. Thank you for your amazing setup and the levels you always highlight to us. Hey, man, great to have you back. My pleasure. Last but not least, on my list at least, I just wanted to touch on 3 popular trades. Here's Bitcoin testing its high day close. Now, we talked about this trade since last week, and the pullback off of that 618 found support at the lower parallel. Here's the break we were talking about yesterday. This is big resistance. Anything beyond 57,500 on a daily close basis essentially puts you back in breakout territory. 66,000 would be the first slope encounter on the upside. So keep an eye on Bitcoin. It's make or break right here today into the close of this week on the back of this, what, like 8-9 day stretch, 7-day stretch. Be careful. Be careful, and something to behold for sure. We have another quick look at the US 10-year. I just wanted to, again, touch base on this. On Monday, on the webinar, we just wanted to highlight that everyone's making a fuss about yields. And while absolutely it was a breakout back in February, this is where you want to be careful. And in fact, for the last 3 days, we have been seeing yields drop. Now, the whole trade is still constructive. The divergence signal is still there. That sort of support trigger I was talking about earlier in the week, the 3-point touch, looks like it's breaking, right? Key support still comes in at the monthly open. That's at 141. That's for the US 10-year yield for treasuries. Last but not least, just from a reference point, I also wanted to highlight the oil trade. We talked about this as well, specifically as it pertains to the weekly chart, because, well, here's the daily. It's a mess. It's just, we kind of need to rework these levels. I think this slope is sort of done at this point. And you kind of take it on the merits. Here's the weekly chart, which is where our focus was earlier in the week. So there's the 10-year. Again, we've dropped a pretty 4 days since, or 3 days since that. We've pushed 3-day consecutive decline. Here's crude as it looked earlier in the week. Here's how it looks now. The whole week has still been predicated on this key zone of resistance. And we're still there. And we're still there. So lots of implications, guys, for these levels as we head into next week with all that major event risk on tap. You have these trades that are pushing critical trend extremes. So let me jump into, that's all I got. Let me jump into your questions, Marcin, and your list there. You have Euro CAD, Euro Oz, and Pound Yen. Let's take a look. Euro CAD. Big breakdown. So looks like it's mid drop. You know what I mean? I'd like to see it lower sub 52, but from here, I wouldn't be too surprised to see some back and forth. Okay, that's the low day. That's the low close from April 2020. And I'm just not so crazy about this 100 anymore. So let's just clean that up. Yeah, I don't know how much this helps, Marchant, but these are the levels I'd be looking at as sort of your key takeaways on this. That's your bearish inval. What's the significance of that level? That's the high from 2016. Wow, it's been a major pivot in price all these years. So converges on the upper parallel, but I don't necessarily think you get that high, and just lower is that key 618. This is the bigger region for me. I'd love to see a drawdown into this zone. How big this recovery, how big this bounce gets, it's kind of the same question that we're asking across all the other majors, right? Dollar rammed into resistance and is pulling back. How deep does that pullback get? Here's a break, run into support. How big does this rebound get? I don't think it gets too big. But just some food for thought there on Euro CAD. What was the other one? It was Euro Oz, which might be a little more interesting. Yearly open support from 2018. Real tight weekly opening, real tight monthly opening range that looks like it's trying to press a break. Watch this. I mean, it's just the same problem with this key zone. But watch this break here. If we do pivot and move lower and the opening range for March proves to be a bearish break margin, you still have to contend with that 52.26 level. That 52.26, 52.75 level is just key. You see how many highs and lows have been in there? Look all the way to the left even. Still pivots. Still pivots. Still pivots. Huge region. So this does shift the focus lower if it closes here on a monthly opening range break. But again, support is support. So not really sure this is a trade I'd be interested in either. You know, I kind of want to see something with a little bit more of a conviction range break. Now, if this does end up being like sort of the dollar CAD trade, right, where it's kind of, it just ripped us into support, stopped us out, turned higher, and it's gonna mount an assault, then we'd need to see that basically hold support into that parallel. And pound yen, I haven't been taking a look at the Widowmaker in a while. Yeah, I would suspect this has got some more upside. So slope resistance comes in just a bit higher. I think it's a decent slope. Again, the median line break was pretty clean here. So a little bit higher into the 52 handles, a nice round figure, big figure resistance, but more so that 88.6 comes up just higher at 52.90. Let me just see this on the weekly chart. Pound yen. Okay, so this is why we run our multi-time frame. So it turns out it's 100 off the low from last year. The entire rally takes you into 51.76. We're pretty darn close. We're pretty darn close. Keep an eye on that. If you look at it on the daily chart, that same slope we were talking about, a modified pitchfork off the lows, well, the upper parallel is right there as well. They don't call this the Widowmaker for no reason, guys. Be very careful and always grant this trade its respect because it will it will rip you apart. Um, it's a one-sided trade. Once it chooses direction, it can go. And every time you try to play the resistance trade, sometimes it's just so shallow you don't even get anything. It's classic pound stuff. So just watch this region to 51.76. The whole region to 52 is pretty important. Pretty important. Hey, Iman says, I got an email from IG stating that there is a change in the time of your webinar and the two meeting times, first on Wednesday the 17th and the second to be on Wednesday, April 7th. Don't mind those emails, Iman. Here it is. We're actually I started that new pilot series for them and they're alternating analysts on. So I will be on that platform for a Wednesday market update on March 31st. That's the next time I'm there. Otherwise, we're right back to normal next week. So the free session on daily effects on Monday, right here on SB on Tuesday and Thursday, and that's going to stay that way until March 31st. Next Wednesday will be James Stanley, a colleague and friend of mine, and the week after that they'll have another analyst on there, and then we'll cycle through. So I hope that clarifies there, Eman. And last but not least, you want to take a look at pound kiwi, was it? A pound kiwi. Mm. Mm. Put a pistol to my head. I would put a pistol to my head now. I would think this is going to correct lower. Now, I'm not necessarily bullish kiwi. You know what I mean, Marchin? I take that approach from a momentum standpoint. This is a pretty, in my opinion, my humble opinion, this is a pretty strong divergence signal. Both reference points are pretty close to the 50 line. That's exactly what you want to see as price actions pressing into a higher high and the oscillator fails to prove that extreme. So I do think from a momentum standpoint, it looks tired. The other thing is, if this was a legitimate trendline break or if this was a more significant slope break, uh, well, that's pretty pitiful, right? I'd expect to see a larger breakout. So I kind of have no conviction in this. Remember, this is also a 2-point touch, which, you know, any 2 points can make a resistance trend line. I know you can drop it and try to put it like this, in which case, well, oh, now it's struggling. But we could do that all day long, guys, and that's where you start to get too subjective. So I'm just of the mindset that the uptrend looks a little tired here, but I can't get too excited about a kiwi long, which is essentially what you'd be doing here on a sterling kiwi short. So one other thing on this margin that is very similar to what we've been seeing in other assets is the fact that we made Something's up with this. I'm sorry about that, guys. What I wanted to highlight, Marcin, is the outside daily reversal into the highs. Remember, that's also exhaustion. Those are great reversal candles when an outside reversal higher happens at the lows, like it did here, right? But when it happens to the upside into the highs and a fresh yearly high nonetheless, that's sort of that's a classic exhaustion trade. And one of the reasons that I wanted to bring up gold was because that's exactly what that did near the lows as well. Well, this is looking at Kiwi, but you get the picture. I think TradingView's done with me for the week, guys. So with that, we'll go ahead and wrap it up. Listen, the ranges abide. Don't get too aggressively positioned in anything ahead of next week. I do think we're going to get a lot of volatility, a lot of kickback as we get into the FOMC specifically. As we get deeper into the quarterly projections, the dot plot, the language, don't forget the stimulus package has passed, right, guys? So that's out there. This call that we're going to start to see more radical inflation, well, that might actually come to fruition now because the liquidity is out there. It's print. So energy prices we see, and I think are going to be one of the biggest offenders of the inflationary target. That said, does that filter into the Fed's outlook? Does that push the Fed in one way or another to start to say, well, look, they've already basically told us rates aren't moving anytime soon, but if they continue this rhetoric with, oh, inflation is going to start to rear, remember the Fed there's always a lag in the utility of their toolbox. When they implement a new policy, there's always a lag. So they always want to front run inflation. So if they wait till inflation starts to rear its head and then they start to react, that lag can see inflation get out of hand. And I can't believe we're even talking about inflation because this is a phenomenon we haven't seen in years. But the rates and the moves we've been seeing in yields, the language we've been getting from not only the Treasury but also Powell, it suggests you need to pay attention. You need to pay attention. So guys, stay nimble on your positioning. Keep some powder dry until we get into the Fed next week. By the part of dollar CAD for the trade that we've been following most begrudgingly in the last couple of days with this boring move, watch this major key support. It's all about how we react here, and we do have CAD employment figures on tap tomorrow. And again, FOMC on tap next week. Lots to look forward to. Best of luck trading, guys. Have a great weekend. Thanks, Jay, Iman, Agnes, Marcin, Steve, Ted. Have a great weekend, guys, and I will see you on Monday. Cheers.